A woman's relationship to money is a little bit different than a man's. And this is obvious given that we've historically earned less. Our mothers and our grandmothers were not seen as the money person in the family, which leaves some lasting money mindset issues we've had to grapple with. In trying to juggle all of this baggage, the question is, should we be investing differently than men? And the short answer is yes. Watch the video to find out more. Hi there, I'm Michelle. Welcome to my channel where we talk money and having more of it. In this video, we're going to take a look at why women should invest differently to men. And spoiler alert, it's not because we are afraid to take risks or bad investors. Not actively investing is not an option for women because we are already on the back foot thanks to the gender pay gap where women earn on average 85% of what men do. And trying to accumulate a nest egg in a low interest earning savings account isn't going to cut it in light of the fact that we are earning less. We spend time out of the workforce to look after our families and we live longer. So how should we invest differently? Let's take a look. So firstly, you need to understand your goals. So I know when I started investing, I did it because I had some broad perception that this is what you should do with your money. Frankly, I had no idea why or what my goal was, and as a result, I dedicated the smallest possible allocation to my investments. I got easily derailed and I didn't have a strategy behind what I was doing. Fast forward many years, way too many years, and the penny dropped and it became clear that investing is simply working towards the goal of building security and wealth to live a comfortable life. So of course I had to define what my comfortable meant in terms of my short-term, my medium and my long-term goals, because then I would understand how much I needed to invest now to achieve those goals, as well as which investment vehicle would suit those goals best. So by this I mean, for my short-term goals, which are less than 5 years, a savings account is the best way to do it because you don't want to risk putting your money into the volatile stock market. For my long-term goals, that would be my pension because that's my retirement. And for my medium-term goals, I knew that I needed an accessible investment account that I could get my money out of before retirement. And in the UK, we have the ISA, which is a tax-efficient investment account that enables you to do that. So once you have defined your financial and your life goals, investing becomes so much less about what I have to do and so much more about what I want to do and what I'm passionate about achieving. Secondly is understanding your investing style. This is understanding your risk tolerance, the what is going to keep you awake at night factor, and your risk capacity. How much of a loss could you weather in your portfolio were there to be an extended market decline? And this is usually driven by your other resources, such as your savings accounts, your cash buffers, and your ability to increase your income sources. Now, contrary to popular belief, women are generally not more risk averse than men, but we do tend to be more risk aware. And this can translate into us erring on the side of caution. Lastly, understand how passively you want to invest. There's an option for everyone, from having a financial advisor manage your money to choosing a ready-made portfolio on a platform or to doing it yourself and building your own investment portfolio. Now choose the approach that's going to get you started, as the earlier you get started, the more time your portfolio has to grow. Thirdly, keep it simple. Whether you choose the totally hands-off approach or some version of the hands-on approach, do your research and understand what is happening with your money. Ultimately, no one is going to care about your money as much as you do. So never assume whatever is being done is the best for you. Find out first. However, don't let yourself get stuck in analysis paralysis. If you are stuck, seek out a financial advisor, a wealth coach, or a trustworthy person who is qualified to answer your questions and support you without having an ulterior motive. Fourth, diversify. Working towards your financial goals doesn't have to be the one-dimensional approach of only investing in the stock market. Plan to build alternative sources of income. For example, building up a property portfolio, starting a side hustle, or even jumping fully into your own business. The more sources you have funneling money towards your financial goals, the faster you will achieve them. Fifth, review what you are invested in. Take a look at your pension. I honestly got the biggest shock when I eventually woke up to the purpose of investing and took a look at my pension. It was almost totally invested in low risk, low return money market funds. WTF! Don't let this happen to you. My mistake was choosing the conservative options when I was asked to do my pension selection, and this was based on the Armageddonish risk questions the selection tool had asked. In reality, the biggest risk we face isn't losing our money in the stock market. It is not letting it grow enough and running out of it in retirement. So when you do those risk tolerance questions, whether you're asked by the investment platform or even by your HR pension administrator, take the recommended risk portfolio level with a grain of salt and err on the side of risk. You want your portfolio to be skewed towards the assets that are going to grow your portfolio, and these are shares, also called equities. So shares are the growth engine of your portfolio, and the longer you have until retirement, the more of your portfolio you want in shares. And even if you are closer to retirement, you still want a significant percentage of your portfolio invested in them. Lastly, invest according to your values. Now, investing is not only about building your wealth so that you can live comfortably, it's also about using your money to make the changes you want to see in the world. And for this, you don't have to wait until you have accumulated wealth. You can do this as you accumulate wealth by investing in assets that have a positive social impact. This enables you to really connect with your money in a positive way that has real meaning and makes the whole process of investing a much more engaging activity. And while this case can be made that we're not really investing that much differently from men, the whole point of this is to show women that we should realize the approach we take to investing, it doesn't have to be a one-size-fits-all. When it comes to investing, it's fluid and it's malleable and it's open to your interpretation, and you can mold it to suit how you want to do it. So investing like a woman simply means investing in line with your goals, your values, your risk tolerance, your interests, and your lifestyle. For more talk about the markets, money, and other things that build a wealthy life, pop over to herwealthiq.com and sign up to my newsletter. If you like this video, please let me know by liking it and share it with any other ladies who want to change their financial story. And for financial education and money talk designed for women, please subscribe to my channel. Thank you very much for watching this video.